Have you ever watched a rocket just take off, soaring into the sky, only to see it suddenly sputter and go sideways? Well, that's pretty much what just happened with SanDisk, ticker SNDK, which was one of the absolute hottest AI stocks out there. It was on this incredible, meteoric rise, and then, boom, it just hit a wall. So the big question is, what on earth happened? All right, first, let's just get a sense of the scale here. We're not talking about just any stock. Over the past year, SanDisk put up an insane, almost unbelievable gain of over 1,200%. You heard that right. Investors were convinced its super-fast storage was the secret sauce for feeding all those hungry AI GPUs. The momentum looked absolutely unstoppable.
And then, the floor just fell out from under it. On March 19th, the stock is flying high, hitting an all-time peak. But just a couple of days later, it starts to bleed. And by March 25th, it's not just sliding, it's in a steep, painful freefall. That rocket ship wasn't just tumbling, it was in a total nosedive.
So this is really the mystery we're trying to solve here. How does a stock that seems to have everything going for it just fall off a cliff like that? You have to wonder, right? Is this a huge red flag for the company? Or maybe for the entire AI sector?
Okay, let's get into it. The answer, it turns out, isn't just one simple thing. Nope. What hit SanDisk was really a perfect storm, a nasty combination of a huge threat from the outside and a really controversial move from the inside, all happening at pretty much the same time. So the first clap of thunder in this storm came from a place nobody really expected, Google. They dropped an announcement that sent this wave of fear through the whole memory chip industry, and SanDisk was standing right in the eye of the hurricane.
Google introduced this thing called TurboQuant. Now, to put it in simple terms, it's basically a new, way more efficient recipe for running these huge AI models. Think of it like a software update that suddenly lets your computer do way more work with the exact same amount of memory.
And this news kicked off an immediate panic. See, Google was claiming TurboQuant could cut memory needs by up to 6 times. This sparked a massive fear on Wall Street. The thinking went like this: if AI gets that much more efficient, does that mean the insatiable, never-ending demand for physical memory chips is about to hit a brick wall?
So while the entire market is freaking out about this threat from Google, SanDisk decides to add its own fuel to the fire. They made a big strategic move that became the second part of this perfect storm. The company announced it was plunking down $1 billion for a roughly 4% stake in a Taiwanese chipmaker called Nanya Technology. Now, this deal also came with a long-term agreement to buy a specific kind of memory called DRAM, which, as you know, is a super critical component for AI hardware. And this deal immediately split Wall Street right down the middle. On one hand, the bulls were saying, this is genius. They're locking down their supply chain when chips are hard to get. But the bears, they saw $1 billion getting spent on a teeny-tiny stake in a company in a really geopolitically risky part of the world. It was seen as either a brilliant chess move or a reckless gamble. So you've got all this chaos, right? A tech threat, a risky bet. How do you possibly figure out if this drop is a legit crisis or just a bunch of panic selling? Well, to cut through all that noise, we can actually turn to the toolkit of a legendary investor.
And that investor is Peter Lynch. He had this famous saying that the real key to winning in the stock market isn't about avoiding the dips, it's about not getting scared out of great companies when they happen. And honestly, his framework is perfect for a situation exactly like this one.
Lynch had this awesome, simple rule of thumb for checking if a stock is fairly priced. He basically said that a company's price-to-earnings ratio, what you pay for the stock, should be about the same as its annual earnings growth rate, what you get from the company. So let's see how SanDisk stacks up.
All right, first up is the price part of the equation. SanDisk's forward PE ratio, which is based on what analysts expect it to earn, is sitting right around 22.4. So remember that number, 22.
Now for the growth part. This is where it gets interesting. Analysts are forecasting SanDisk to grow its earnings at a massive 46% a year. That's a huge number.
Okay, so let's put it together. You've got growth at 46% and a price tag of about 22. The growth rate is more than double the PE ratio. According to Peter Lynch's golden rule, this isn't just a fair price, it's a potential bargain. The company's engine is growing way faster than its stock price is. And when you look at Lynch's other checkboxes, the picture still looks pretty good. The story, a leader in AI storage, is still solid, even with this new TurboQuant plot twist. And maybe more importantly, its balance sheet is a fortress with almost $1 billion in cash and not a lot of debt. The only thing you'd really have to watch is inventory,
If that starts to pile up, that's a classic sell signal for a chip company.
And now for Lynch's final check. He used a little formula, basically growth divided by PE, to get a final score. For him, any score over 2.0 was considered excellent. And SanDisk? It gets a 2.05. It clears that high bar, even if just barely.
So where does that leave us? On one side, if you look at it through the lens of a legendary investor, the fundamentals look incredibly strong. But on the other side, the market sentiment, the charts, they are all flashing bright red warning signals. So which one is right?
This table really lays out the two warring stories perfectly. You have the bull case, the Peter Lynch view, which sees a cheap stock with a rock-solid balance sheet. Then you have the bear case, which sees a stock that was already priced for perfection and is now facing this game-changing threat from Google. Not to mention some pretty bad timing with insiders selling shares.
So, when you put it all together, the big takeaway is this. The risk-reward has totally changed. Yeah, the company's fundamentals still look really solid, but after that massive run-up, that margin of safety, that cushion you have against bad news, it's pretty much gone. The easy money here has almost certainly been made.
And that leaves us with this one last really interesting question to think about. When you're looking at a company that's at the heart of a genuine tech revolution like AI, what matters more? Is it the long-term story of the business, or is it the short-term panic and volatility in the stock price? That's the billion-dollar question, isn't it?